class, and I went out and picked up a paper.
I had to ask Kevin to leave his office and come and pick me up.
Well, what are friends for?
Yes, and he is a friend, Jerry. He's reliable. He's considerate. He's like your exact opposite.
So he's Bizarro Jerry.
Bizarro Jerry?
Yeah, like Bizarro Superman. Superman's exact opposite. Who lives in the backwards Bizarro world. Up is down, down is up. He says hello when he leaves, goodbye when he arrives.
Shouldn't he say bad bye? Isn't that the opposite of goodbye?
No, it's still goodbye.
Does he live underwater?
No.
Is he black?
Look, just forget the whole thing, all right?
So there are three Seinfeld characters. You met Bizarro Jerry, there's George, and there's Kramer. Elaine goes on to meet two other characters, Kevin, Jean, and Feldman. So there's three Bizarro Seinfeld characters. I'm going to give you three Bizarro things we're seeing in the market tonight. The first one is inflation. So the blue line is headline inflation. The red line is core inflation, so X, food and energy. 2% is considered to be the target for the Federal Reserve. They want 2% inflation. In a normal recovery, we would expect inflation to be at least maintaining its level, not declining like we've seen. So this is a Bizarro World impact. You have growth, and yet you have lower inflation. Now, this is such a bizarre thing that we don't have a term for it. We have a term for the opposite, which is stagflation, where you have no growth in inflation, but we don't even have a term for this, for inflation, no inflation with growth. And an article I read in the Wall Street Journal proposed a few ideas: growflation, low inflation, coal growth, but it's such a bizarre thing that there isn't a name for it yet. This isn't actually what I think is the most bizarre part of the inflation part of the market. It's that this is considered a bad thing. To me, low inflation is a good thing. Now, I concede that there is bad low inflation. So, for instance, bad deflation if it's due to weak demand growth. If you have sticky wages and low inflation, it's bad for corporate earnings. And most of all, the third one, people say, is it can result in a deflationary spiral, like you had in the Great Depression. But there's also good inflation, such as due to falling import prices, let's say low oil prices, or a strong dollar, just like we're seeing today, due to technological advances, all of which combine to increase your purchasing power. I would maintain that this is the kind of deflation or disinflation we're seeing in the market, and that's a good thing. So why are people talking about how this is bad and you want to create inflation? I think that's a Bizarro World impact. The next one is, again, this is showing 10-year bond yields for Canada and the US. And last year, they declined, not just for a period of time, almost for the entire year. Now, if you've got a stronger economy, you'd expect interest rates to move higher, not lower. I can tell you, not a lot of people in the markets got this right last year. This is a Bizarro World impact. But the real epitome of the Bizarro World, in my opinion, is the third one, which is what we saw in the global markets in Europe, in Northern Europe. This graph is showing, and the red line is where interest rates are zero. It's showing the two-year bond yields of Denmark, Sweden, Germany, and Switzerland. Not only did they move lower throughout the whole year, but they moved below zero. So in our world, if I lend you money, you pay me an interest rate. In the Bizarro world, I pay you an interest rate. And I can't think of a better example of a Bizarro World impact than that. So let's see now, what is causing these Bizarro World things? Well, the biggest thing is what I refer to as the two-speed economy, which means the US growth is getting better and the rest of the world is getting worse. And if you look at this graph, it shows the IMF estimates for 2015 growth and how they revised their growth rate estimates in January. Basically, they revised the US growth up 0.5%, and everyone else they declined. Everyone in the G7 and the BRIC nations, they lowered. And I show Canada there. And I also show Italy because I'm going to use them in a series of other examples. But all of them, their growth rate has been cut. Now, this has implications for the bond market and those lowering interest rates that we saw before. So again, 10-year bond yields, the US and Italy. Now, the point I want to make with this is when we talked about lower interest rates in the US weren't going down because of what was going on in the US economy. It was what was going down in the global economy. Because whereas you could maintain that the environment should have been in the US for higher rates, it does make sense in Italy that rates should go down. And it's a global marketplace. And if you have the ability to invest in the US at a higher yield and in the US currency than you would in Italy, that's what you're going to do. And that capital flow into the US is going to drive yields down to the US, down to where they are in Europe. So it's what's happening in the Eurozone that is driving US rates down, not what's happening in the North American economy. Now, the next one, and what I think is an outgrowth or a cause from the two-speed or a cause of this two-speed economy, is deleveraging. Now, deleveraging in the whole world added a lot of debt before the Great Recession, and it's what happens when you add debt is you're borrowing from future growth. As you pay that off and deleverage, it's a headwind to economic growth, and the U.S. is further along that curve than the rest of the world. If you can see from this graph, the red and the blue line is showing debt to GDP for the US and Germany. When the line is going up, that means you're accumulating debt. When the line is going down, that means you're deleveraging. And you can see from this, the US and Germany have both been declining. The black line is the industrial country average, and you can see that has not started to even off. It's kept on going up. And according to McKinsey Corp, again, if you look at where growth was, debt to GDP for the global economy in the year 2000, it was 246% total debt to GDP. Just before the Great Recession, it went up to 269%. So you saw that leverage be added before the Great Recession, what we think is one of the causes of the Great Recession. But look at it now. In 2014, it went up to 286%. There's been no deleveraging. In fact, it's been continuing to leverage up. It's the U.S. is one of the few countries that has actually been able to lower their debt to GDP. And that's one of the reasons why you see stronger growth in the U.S. So what do you do? What can countries do to get their debt to GDP moving in line with the U.S. and trying to lower that? What is the U.S.'s secret? Well, if you want to decrease your debt to GDP, you have to do one of two things. You have to either increase your GDP or lower your debt. So let's have a closer look and see what exactly the U.S. is doing.